So now we're going to wrap up with Asia, and we wanted to start with China and what's happening with the US dollar and the strength there. And you can see just how big of a hit this has been when you look at the activity versus the CNY, the CNH in terms of onshore, offshore. And you're seeing that it's the worst it's been since 2008. So this is below COVID, and this is why the PBOC has had to step in and trying to do something to just protect the currencies, to maintain some stability, but it's costly. And that's why when we talked previously, and then when the new data comes out, because China's been a bit light this past week on data, picks up again next week, there's going to be more to talk about because the FX reserves keep bleeding down. And as we talked about in segment one, they're losing exports because the U.S. isn't buying as much. So you're seeing a big decline into both the West and East Coast. It's what we've talked about consistently on the EIA show. So how are they going to naturally bring in dollars, which now puts them back into essentially back into how do they protect, and they have to go out and buy dollars outright, which is bleeding their FX reserves because they're liquidating they're liquidating treasuries to purchase dollars, and then it goes right out to try to balance their, again, trying to stay in front of inflation, trying to stay in front and stabilize currencies. And as the yen wants to just break away to brand new highs, that's going to put even more pressure on China in terms of that devaluing versus the yen trying to maintain competition. And all of this comes back to the US dollar, which is why we don't see volatility getting any better, just given the amount of movements we've seen in the FX regime. All the while, the Chinese economy is facing some deflationary pressures, but it's mixed, because when you look at producer goods, so PPI is coming down, but consumer goods are staying higher. When you look at food still remains elevated, different pieces of it. But the reason why you're getting such a big drop in some of the CPI and PPI side is construction. When you look at infrastructure spending, when you look at housing construction, it's through a floor. So with that being down, which has been a huge absorption of just assets in that region, with that coming down, that's where we're seeing a lot of this decline and a lot of that pressure as we go forward, which is good for pricing. But again, you're still not seeing the consumer spending to the same level, which is keeping pressure on the economy because exports are slowing. Government spending, they're trying, but the deficits are becoming onerous, so that is going to slow. So you need in the investment, which is declining. We have a chart on that. And then you're left with the consumer, and the consumer has clearly said they are not willing to spend and continues to be a pressure point. And that's when you look at the falling lending rates since 2019 have put more pressure on bank margins. So you're looking at banks that are already struggling. They already have insane leverage ratios. Now you're asking them to reduce the already very low levels of hurdle rates they have, which is increasing bad debt expense, increasing bad debt in general, while providing less support. So again, they're putting their banking system on the precipice of a huge problem, which is already there. The problem has been there since 2011, has only gotten worse. Now you're seeing a slow-moving collapse, and you're asking the banks to leverage themselves further and essentially destabilize themselves and their balance sheets to a level that if anything, when something happens, how do they step in? How does this all move all the way through? And again, that's why we think there is a massive problem that is only going to get worse, because when you're increasing the leverage ratios, every dollar it's exponentially worse. So as the bad debt expense expands, that's when we're going to have more problems. So now when we start looking at Chinese property sector year on year, you get an idea that there is not a single place that is doing well. They're all negative. They're all slowing. And this is something that not only the banks rely on, but also the local governments. So you're getting stress on both levels. You're getting issues on both sides. and it's not getting any better anywhere, which is again why we see the pressure and that stress point getting exasperated as banks are asked to do more, as their portfolio, their collateral continues to devalue. So not only are they lending more at lower rates, at a leverage ratio that's already over 30 times, 34 times on average, with less protection because they're cutting interest rates to do it, while the asset pool that they've used to collateralize their bad debt is shrinking. Again, I don't know how I can describe it any better than this is a recipe for disaster. So then when you look at just the private credit impulses, it's important to look at excluding local government bonds and including local government bonds. When you exclude local government bonds, the credit impulses is flat. Nobody is borrowing outside of the government entities which are being forced to do so or being asked to do so to bump up those impulses. But even at a bumped up level, look at how low it is. There's no movement. Nobody wants new debt. Everybody's trying to shrink their balance sheet. And again, this is just showing that seizing up of the system. And then the subdued loan growth despite lower interest rates because there's no demand. So when you look at the 3-month SHIBOR inverted, technically it's getting cheaper. But this is what we've been saying. It's not a supply problem. It's a demand problem. People don't want it. Companies don't want it. So you can make rates whatever you want, and you can see they have, and there's still no bank loans coming across, which is, again, showing just the stress in the system. And then hot money. So capital flows not related to trade and likely speculative continues to exit China at a similar pace to the yuan devaluation in 2015. We don't see that stopping based on the pressure points we've highlighted and we've been talking about. People have said we've been crazy. But again, we made the call on February 16th of last year that China reached its peak and now it was going to see a massive decline. And this is easily the worst property market downturn on record. Under construction, starts, volume, everything is negative, and we don't see that changing with China real estate transactions year to date. Residential square meters year over year is negative 24.5%. Again, this is a huge issue for local governments, federal government, PBOC, and more importantly, banks that are over levered to this area. All the while, Chinese real retail sales are flat to down. The trend has pivoted, and this is that last piece that Xi has been trying to prop up, trying to push, and now the consumer is slowing down again. Now, before we get into Japan, we have to talk about the view that there was a coup and that Xi was going to be essentially captured and there was going to be a change in government. Now, Xi doesn't have complete control. He has control, obviously, but there's still dissenters within it that he has to try to make happy. They're in Guangdong, they're in Shandong, they're Beijing, they're Shanghai. There's a lot of people that are a bit more capitalistically minded and are very much against the continuous usage of lockdowns. But the commentary came out. So Xi traveled internationally to Central Asia to meet with Uzbekistan and some other dignitaries, and then he came back. There is a mandate that you have to quarantine for 10 days. He happened to do it in his house. That turned into that he was under house arrest because there was a coup going on. No, that was just, and again, there's people are picking up on the dissenters, and they're becoming more vocal because next month is the Communist Congress. They're trying to make sure that if Xi wants to maintain his level and status and get his third term, they need compensation, and that's why they got noisy. And then that got spun into the fact that Xi is under house arrest and the politicians and the CCP was changing. That is, again, inaccurate. So just wanted to clarify that before we go to Japan. So now as we look at Japan, who's been doing QE since 1998, CPI year on year, including top line contributions, is moving back. It's at 3%. And then when you look at including top line contributions all the way through in terms of the different levels, you can see just how elevated. And this is why we expect to see the BOJ start to raise rates. This would be a huge pivot. And again, they have no choice. And this is how QE comes to die, and that's where the last bastion of it in general. Now, when you look at South Korea, FX reserves are falling. So when you look at reserve import, that's what we've been talking about. The imports are slowing. So as reserves slow, as exports slow, your FX reserves are going to dwindle. So the current account overstating external trade picture continues to pull lower with the trade balance in the current account. Currency reserves have declined to reduce the drop in the Korean won. However, rising prices of imported goods, especially energy, have placed South Korea's import cover ratio at decades low. South Korea's current account is still holding up, mostly due to the accumulation of corporate profits, according to PGM Global. Meanwhile, the trade balance has deteriorated. So because, as we said in segment 1, you have microchips slowing, you have semiconductors slowing, you have technology and just electronics slowing, and that is a huge piece of their budget. So they're naturally taking in less dollars as their input costs continue to go up because imports are elevated. And as energy and everything else, what we've been talking about is import prices are remaining high, similar to the 1970s, where even though demand has come down, there is a broad shortfall in the market, which for raw materials, which is why import prices are up. And that's keeping that stress on inflation and shrinking, obviously, U.S. dollar availability, FX availability, and the additional problems that we continue to see. So that's what we have for you on the Econ Show. If you have any questions, again, feel free to reach out. We're going to have more to talk about. A lot of things remain fluid. So we'll follow us on Twitter. I'll continue to provide updates there, and then obviously do the deeper dives as they become relevant and important on our shows. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.